All right, in this video, I'm going to cover the number of days in the cash conversion cycle, right? So we are acquiring inventory, selling inventory, and theoretically we use cash in the acquisition at some point in the acquisition of inventory, and then we receive cash at some point in the sale of inventory. So the question is, how long is the receipt of cash relative to the use of cash? All right, so that's the cash conversion cycle. The formula for the cash conversion cycle is days sales in accounts receivable, right? So we make a sale, how long does it take usually once something enters into accounts receivable? How long does it go from the sale to cash? That's days in accounts receivable. Days in sales in inventory. So how long is something sitting on the shelf? And then finally, days payable outstanding. How long does it take for us to pay our accounts payable? The combination of those three is how we determine the cash conversion cycle. Okay? So one step deeper, days sales and accounts receivable, that formula is accounts receivable divided by net sales times 365 days. Then we have days sales in inventory, and that would be inventory divided by cost of goods sold times 365 days. And then finally, days payable outstanding, accounts payable divided by cost of goods sold multiplied by 365. Pretty straightforward. So here's an example for our particular current year, right? So we have first, let's do days sales and accounts receivable. And the assumption is we have 1,430 in accounts receivable. We have net sales for the year, or for the period, 15,620. So accounts receivable divided by net sales of 15,620 times 365 days gives us 33 days. Then we do sales and inventory. Excuse me. Again, our inventory assumption is 1,484. Cost of goods sold, 10,056 divided by inventory divided by cost of goods sold times 365 days gives us 54 days. So we're saying the minute inventory lands on our shelf, it generally takes about 87 days for us to turn that into cash. Okay? And then let's do accounts payable divided by cost of goods sold times 365. And that gives us our days payable outstanding, right? So 2,120 divided by 10,056 times 365 is 77 days outstanding, right? So we purchased inventory and we are not paying that for 77 days. Then once we pay that 77 days, remember we have 10 more days till we receive the cash from the sale of that inventory. So we're really, waiting for cash for about 10 days on average. That's pretty good. However, the previous year, we were waiting on cash for about 8 days, right? So something this particular year led to a slightly longer cash conversion. And it looks like we are purchasing maybe more inventory than we need to, and we have more inventory on the shelf, and it's taking us longer to convert that inventory into sales, right? That seems to be the one thing that jumps out at me. Cash conversion cycle.